The book Beating the Street was written by Peter Lynch. He is a well-known investor who worked for a company called Fidelity Investments. He managed a big fund called the Magellan Fund, which became one of the best-performing funds during his time. Lynch wrote this book to help regular people understand how they can invest in the stock market. He believes that anyone, not just professionals, can make smart investment choices if they learn the right way to do it. In the book, Lynch shares his own experiences from working as a fund manager. He explains how he picked stocks and why some investments worked better than others. He tells readers that they don't need to be experts to invest well. Instead, they should use what they already know from everyday life. For example, if someone notices that a particular store is always busy, that could mean the company is doing well, and its stock might be a good investment. This means that everyday consumers often have insights about businesses before professional investors do. If someone notices a new type of shoe that is becoming very popular, that could be a sign that the company making the shoe is growing and might be a good investment. Lynch encourages people to trust their observations and use them as a starting point for deeper research. Lynch talks a lot about the importance of doing research before buying stocks. He suggests that people should study companies, look at their financial statements, and understand how they make money. Financial statements might sound complicated, but Lynch explains them in a simple way. He tells investors to look at how much money a company is making, how much debt it has, and whether it is growing. One of his key points is that a company with a strong track record of making profits and growing over time is usually a good investment. He also believes that patience is important. He explains that the stock market goes up and down, but people who stay invested for a long time usually do better than those who try to buy and sell quickly. Many people panic when stock prices fall, but Lynch reassures them that this is normal. He says that instead of reacting emotionally, investors should focus on whether the company itself is still strong. One of the main ideas in the book is that people should invest in what they know. Lynch calls this approach investing in your own backyard. He says that people often have an advantage because they see trends before professional investors do. For example, if someone works in the restaurant business, they might notice that a certain food chain is becoming very popular. That could be a sign that the company is growing, and its stock might be a good investment. Another example is parents noticing that their children and their friends are obsessed with a particular brand of toys or clothing. If the brand is growing fast, the company that owns it might be a good investment opportunity. Lynch emphasizes that these small observations can lead to great investment ideas. However, he warns that just because a company is popular doesn't mean it's always a good investment. Investors need to check the company's financials and business model before making a decision. Another key idea is that people should not be afraid to think for themselves. Lynch explains that just because everyone is excited about a certain stock doesn't mean it is a good investment. Sometimes the best opportunities are in places that most people are not paying attention to. He encourages investors to look for hidden gems, companies that are doing well but are not widely known yet. He gives an example of how he invested in a small company that made pantyhose after noticing that its products were selling well in stores. At first, this company was not widely recognized, but over time, it grew and became successful. This shows that investors can find great opportunities by paying attention to what is happening in their everyday lives. Lynch also warns against common mistakes that investors make. One mistake is trying to time the market, which means guessing when prices will go up or down. He says that even professionals can't do this well, so regular investors should focus on finding good companies and holding on to them for a long time. He compares the stock market to a roller coaster. It goes up and down, but over the long term, the general trend is upward. He also points out that many people sell their stocks too early. Many investors get scared when stock prices drop and sell too soon, missing out on big gains later. Instead, Lynch advises investors to be patient and give companies time to grow. In the book, he also talks about different types of companies. He divides them into categories based on their growth potential. Some companies grow fast, while others are more stable. He suggests that people should invest in a mix of different kinds of stocks to balance risk and reward. For example, a person might invest in both high-growth technology companies and steady businesses like utility companies. High-growth companies can bring big profits, but they also come with more risk. On the other hand, stable businesses might not grow as quickly, but they provide consistent returns. Lynch explains that having a mix of both helps create a strong investment portfolio. One interesting experiment in the book involves Lynch comparing the stock-picking skills of students with professional investors. He wanted to see if regular people, especially young students, could perform as well as professionals when choosing stocks. Lynch gave a group of students the opportunity to select stocks based on brands and companies they liked or noticed growing in popularity. Surprisingly, the students' stock picks performed better than those of professional investors in many cases. This experiment proved that people without formal training could still make smart investment choices if they paid attention to everyday trends and did some basic research. Lynch uses this example to show that investing doesn't have to be complicated. Sometimes, simple observations and logical thinking lead to great stock picks. Lynch believes that people should not be afraid of the stock market. He explains that over time, stocks have given better returns than other types of investments, like savings accounts or bonds. He encourages people to think long-term and not worry too much about short-term changes in stock prices. He also says that people should be prepared for ups and downs, but if they stay patient and choose good companies, they can do well. He reminds readers that successful investing is not about buying and selling stocks every day, but about finding strong companies and holding on to them as they grow. Throughout the book, Lynch uses simple examples and stories to explain his ideas. He shares personal experiences, like how he found good investments by paying attention to everyday life. He also gives advice on how to read company reports, how to spot strong businesses, and how to avoid bad investments. His writing is clear and easy to understand, making it a good book for beginners who want to learn about investing. For example, he explains that a strong business is like a healthy tree. It has deep roots, a solid financial foundation, strong branches, a growing market, and it keeps producing fruit, profits. This simple comparison makes it easier for readers to understand what makes a company successful. Even though the book was written years ago, its lessons are still useful today. The stock market continues to change, but the principles Lynch teaches remain the same. He encourages people to take control of their own financial future by learning about investing and making smart decisions based on what they see in the world around them.